have got the time, we would really appreciate it if you just spent 2 minutes just to give us the feedback. There's also a new question in there just to ask if there's any areas or topics you'd like to see covered in any future webinar sessions. So please do have a look at that if you have got the time. Otherwise, Greg, if you wanted to start, you can take away the presentation.
Awesome. Thank you, Jess. 45 minutes to an hour, I think will be a touch long for this topic, but we're going to be aiming for 30 minutes. And then, in terms of taking any future discussions or answering questions offline, I'm happy to do so. My contact details will be at the end of the webinar. But the topic today, capital gains tax. But just before that, I'm one of the advisors at Ascot Wealth Management. So anything that I say in this webinar won't necessarily be construed as advice. This is just from a informative, informational purpose, just to go through the capital gains tax system and also look at the changes that has happened in this tax year and will happen in subsequent tax years. Awesome. So let's get started. So the structure of the webinar, we're going to look at, we're going to cover what is capital gains tax. We're going to look at how CGT is calculated, how to avoid CGT or to mitigate or defer CGT will be of particular interest to many of you on the call, I'm sure. We'll also look at how to use capital gains to your advantage and the ways and mannerisms that you can utilize to lessen or to lower that capital gains tax bill. And then lastly, we're going to look at you and how capital gains tax changes affect you. So that's the session today. As I said, I don't think we're going to be going on for an hour, but we're going to be looking into it and looking forward to the questions at the end of the session. So first things first, what is capital gains tax? So capital gains tax, it just refers to the profits or gains made from selling or disposing of certain assets. Those assets, as you can see there, include property, investments, and certain personal possessions with a value above a specific threshold. It says they're excluding main residence because there is a main residence relief that you do get, which if you're selling your main residence, you're not necessarily going to be levied capital gains tax on selling of that main residence, your private property. But when we're talking about UK property, we're also referring to your second property or your buy-to-let properties. That's where a potential capital gain might arise. All right. So how is capital gains calculated? So this could be quite meaty in its delivery here. So when you sell or dispose of a qualifying asset, the difference between the selling price and the original price is considered a capital gain. Okay. In the UK, capital gains are subject to tax, and that's where you get CGT or capital gains tax. So those current rates at the moment, when we're looking at capital gains tax for an individual, for basic rate taxpayers, it's at 10% on gains above the tax-free allowance. That tax-free allowance is called the annual exempt amount, and up to the basic rate threshold, and 20% on gains exceeding the basic rate threshold. So if you're a basic rate taxpayer and you're earning £40,000 and you make a £20,000 gain, the first £10,000 will be taxed at the basic rate band at 10%, and the subsequent £10,000 will be taxed at 20% because it is above the basic rate tax band. Higher rates and additional rate taxpayers, you get a tax rate of 20% on gains above the tax-free allowance, up to the basic rate threshold, and 40% on gains exceeding the basic rate threshold. So looking at capital gains tax for residential property, that's charged at a rate of 28%, where the total taxable gains and income are above the income tax basic rate band. And below that limit, the rate is at 18%. For trustees and personal representatives of deceased persons, the rate is at 28%. All right. Looking at the next slide here, how is capital gains calculated? So we've got a list of 7 steps that you'll need to undergo. So firstly, we're going to determine the acquisition cost. That acquisition cost, you're going to need to calculate the original price that you paid for, in this instance, or in this example, a property. That's including any associated costs such as legal fees, survey fees, and stamp duties. So in this example that I'm going to pull through these 7 steps here, we purchased a buy-to-let property at £200,000. So that would be deemed as the acquisition cost. Then step 2 is to determine the disposal proceeds. So that's where we need to determine what you're actually selling the property for. And from that price, you can take away allowable expenses like estate agent fees and legal fees. So once you take that away, you can determine your disposal proceeds. So for our easy example, say the disposal proceeds amount to £300,000. Step number 3, now we need to calculate the capital gain. So, quite simply in this example, it's obviously not a very difficult example that we're going through, but you just subtract the acquisition cost from the disposal proceeds to calculate your capital gain. In this example, that would amount to £100,000. Then step 4, we would apply any available exemptions and reliefs. So firstly, you've got to check for any exemptions or relief that can reduce your capital gains tax liability. Those common exemptions and reliefs include the annual tax-free allowance, known as the annual exempt amount, and tax relief for selling your primary residence or principal private residence relief. So in this example, let's assume that you've used up all of your annual exemption and you're not eligible for any other reliefs. So the full capital gain is taxable. Step number 5, now we've got to determine your tax rate. So what we do there is that the rate at which you'll be taxed on your capital gains depends on your income and the type of asset that you've sold. The standard CGT rates in the UK, I've touched on them already, would be 10% for basic rate taxpayers, 18% for basic rate taxpayers on disposal of UK property, and 20% for higher and additional rate taxpayers, or 28% for higher and additional rate taxpayers on UK property. So in this instance, we're going to be levying that gain against that property, being what we've disposed of, at the step number 6, which is to calculate your capital gains tax liability. So simply put, that's where you would multiply your capital gain by the applicable tax rate. So in our very brief and simple example to follow, we'll assume that you're a higher rate taxpayer. You've utilized all of your exemptions. So now you can, if we're talking about a stock or a share, that tax rate would be 20%. If we're talking about a buy-to-let property, for instance, that tax rate would be 28%. So in our example of a £100,000 gain, we're looking at either a £20,000 capital gains tax bill that would need to be settled, or a £28,000 capital gains tax bill that will need to be settled if this is a buy-to-let property. Lastly, that's where you need to go to the taxman, and that's where you need to report and pay your tax. That's obviously got the deadlines, and those deadlines are at the Those deadlines are at the end of January the subsequent year. Great. So looking at ways to mitigate or defer against capital gains tax. So there are a few strategies that you can put in place. Firstly, we've got to utilize those tax-free allowances. So we're in the tax year 2023-2024. Your annual exempt amount in this tax year is at £6,000. That was more than halved from last year's annual exempt amount, which was at £12,300. So what that means is that you can make a gain on an asset of up to £6,000 before you start paying capital gains tax. As you can see, or as you can deduce from last year, you were able to make a gain of £12,300 before any type of capital gains tax would be brought into the equation. Very importantly, annual exempt amount is going down again to £3,000 for the 2024 and 2025 tax year. That will be in effect from that point onwards. There's no updates as to movements in that regard. It is going to be set for £3,000 from next year and beyond. Obviously, subject to change, as we can see with the legislative environment. It is always subject to change. I know Katrina is going to be doing the next webinar on the 22nd of June, which the sign up is above, on the pension legislation changes, and that was a fairly sudden change that was brought into it, and as you can see, that shows you the fairly abrupt nature that could change the tax rates that we have. Second strategy, you can look at transferring assets between spouses or civil partners. That just enables you to utilize that any assets transferred between spouses are typically exempt from capital gains tax. This can be a useful strategy to utilize both your individual's CGT allowances, effectively doubling that tax-free amount per year. The third strategy is to utilize tax-efficient accounts. So, that's where you need to consider investing in tax-efficient accounts such as individual savings accounts, ISAs, or self-invested personal pensions, as investments within these accounts are generally shielded from capital gains tax while it is in the fund. Obviously, ISAs and SIPs have, or pensions have, different taxation regimes when you draw from it. And we've got countless webinars discussing those ins and outs. I won't refer to them in this session, but use those tax efficient accounts to shield away from your capital gains tax liabilities. Offset gains with losses is another strategy. So if you have incurred capital losses from other investments, you can offset these losses against your capital gains. This may help reduce or eliminate your CGT liability, and losses can usually be carried forward to future tax years as well. Step number 5, or strategy number 5, would be to utilize those CGT reliefs and exemptions. I've already touched on them already, but the UK tax system offers those various reliefs and exemptions that can help reduce CGT. There's an example here, entrepreneurs relief, now known as business asset disposal relief, provides a reduced CGT rate on qualifying business assets. Similarly, private residence relief can exempt or reduce capital gains tax when selling your main residence, subject to certain conditions. Then we're looking at the last strategy on this slide here, which would be to hold assets in tax-efficient structures. We've run a few webinars on these type of structures, and those certain investment structures like ISAs, enterprise investment schemes, VCTs offer those tax advantages that may help reduce or defer capital gains tax. And that's summarized in this table over here. And as I said, we have done previous webinars on that. We'll look to, if you request that, we can send those recordings on previous webinars on venture capital trusts, enterprise investment schemes, and that also ties into seed enterprise investment schemes. I've highlighted the CGT relief / deferral column here. I mean, when we're looking at what this essentially means is that we've got in this example, we've got a capital gain that we've made 2 years ago, for instance. We've sold down a few shares. We made a capital gain of £50,000. What an investment in, say, an enterprise investment scheme would mean is that you'd be able to defer that capital gain for a lifetime of your investment into an EIS. So say, for instance, you've made that £50,000 gain in my example 3 years ago. You can then opt to take that gain and invest it into an enterprise investment scheme. You can then hold that EIS investment for, say, 5 years, for instance, which will defer that capital gain. Seed enterprise investment schemes, 50% relief. So in this example, you've taken the £50,000 gain and you've invested that £50,000 into a seed enterprise investment scheme. You'd get 50% relief on that capital gain. So I see some questions coming in. So yeah, keep them coming in. Tim Tanner, John Armstrong, thank you for sending those questions. We'll look at answering those questions at the end of the webinar during that question. So thank you for sending those through, and we'll catch up with them at the end. So as you can see, capital gains relief and deferral, very important that you look into. Once you've made a gain, there are options to either defer or to gain relief by the reinvestment in certain tax efficient or tax incentivized investment products. All right. So is there any, or are there any capital gains tax to pay on the estate? The good news here is that the estate doesn't have to pay any capital gains tax on the property or assets that weren't sold before a person were to die. But if the property or asset is sold during probate and its value rose since the person died, there is usually a tax bill to pay. Now, this could be a nuanced bit of planning, but this could factor into your thinking if you or your parents are elderly and own an asset that could have a significant capital gain on it. If they were to realize and gift it away, or to liquidate that asset to gift cash, for instance, it might, or it may be appropriate for that loved one to possibly pass with that gain. That will obviously save from any capital gains tax that would need to be paid on that disposal of that asset. How do capital gains tax changes affect you? So I've touched on this already. The annual CGT exemption for this year is down to £6,000. Last year, it was at £12,300. And next year, it is going to go down again to £3,000. So how will this affect you? So I'm going to read a bit of stats here. So HMRC estimate that halving this exemption will result in an additional 235,000 people needing to report their capital gains. So there's going to be an extra level of scrutiny needed from 235,000 people to address this. So there's about 100,000 people of those affected who routinely file self-assessments. So if you're thinking over 100,000 people don't routinely file self-assessments, that may be brought into this the capital gains tax net as a result of the halving and halving further of the annual CGT exemption. So, I mean, a little caveat here is that this figure assumes that existing behaviors will continue, but in reality, many will simply reduce the amount of gains they crystallize or realize to just below the new capital gains tax exempt amount each year. And that goes back to a few slides ago, where you're looking at those strategies to mitigate or defer capital gains tax, because behaviors will change. So potentially 235,000 people, more people will be needing to report capital gains tax, but as mentioned here, behaviors do change. So compare this to this year. Clients with an income over the higher rate threshold and gains above the new allowance could be paying up to an extra £1,260 in 2023-2024, with the prospect of a further £600 the following year. It doesn't sound that much, and we're going to sort of proofread that shortly, because for basic rate taxpayers, these amounts halve to £630 and £300 respectively. And of course, these amounts may be higher still if the capital gain is from the disposal of a residential property, and that's taxed at 18% or 28%, depending on your income tax band. So the cut to the exemption will have an even bigger impact for trustees who already only receive half the annual exempt amount and pay CGT at the higher rate of 20%. This will see the exempt amount cut to £6,150 for 2023-2024, falling to £1,500 from the following April. So we've been in a period of relative stability when it comes to the annual exempt amount, and within the next 2 years, and we're in year one of that will bring a lot more people into this capital gains tax net, which from a tax point of view will need to be addressed on an individual standpoint. So what will be the impact in future years? So periodic rebalancing of portfolios and annual liquidation and ISA contributions will be impacted in future years, because if you think of your portfolio and you think of the fact that it might be in an unwrapped general investment account, for instance, if you were to rebalance that portfolio on a periodic basis, because it's not in a CGT shielded environment, buying and selling of stocks and shares within your portfolio will generate a gain or a loss within the tax year. So that annual exempt amount of £6,000 and £3,000 from next year will have an effect when you do rebalance your portfolio. It may be a very time-consuming and costly exercise, because more scrutiny will be on that, the rebalancing of your portfolio. But as you can see here, for a maximum tax saving of £600 from a £3,000 exemption, you need to decide whether that exercise of that scrutiny when it comes to periodic rebalancing on your portfolios is worth it. For a higher rate taxpayer with a portfolio of £250,000, we just looked at just validating that number. What that £600 saving would equate to is the equivalent of 24 basis points, or 0.24% reduction. So it is still an impact and something that you need to plan for. Obviously, the higher amount that you have subject to capital gains, the lower the cost will be of the halving of the exemptions. But there is still value in managing this, and that's what we as financial advisors will be managing over the course of from this point onwards, with a lot greater scrutiny, but especially utilizing a financial advisor or possibly automating that process with your DIY platform may be of benefit for you. Annual liquidation ISA contributions. In that case, I mean, if you have a general investment account, and what you do annually is you look to crystallize or realize £20,000 to send to your ISA, BED and ISA on an annual basis. Now you obviously, with the halving and then further halving of the annual exemption amount, means that you're going to potentially raise a gain by doing that BED and ISA annually. So that would need to be scrutinized, and possibly, if it to save on capital gains tax, realizing or crystallizing a gain within that annual exempt amount will be key when you are doing that BED and ISA on an annual basis. So overall, cuts to the CGT annual allowance potentially mean that more clients will be pulled into the CGT net. So they will also need to be aware of their reporting obligations, as this may not be on their radar before. And as mentioned, the HMRC think that 235,000 people, more people, will be pulled into that net. So that's something that you'll need to factor in from a reporting standpoint. Last thing I'll say in this regard is that advisors, we do play a critical role in helping clients who are trying to maximize their annual exempt amounts or this year's allowances, and in helping keep future liabilities to a minimum. So those are the changes, and that's the capital gains tax landscape at the moment. I will hand it back to Jess, and we're going to go through any questions that have been coming through.
Yeah, so we have got a couple that have come through now. So let's have a look at some of these. First one we've got is from John Armstrong. Let me just see if we can get that up.
It's a very good family name, John.
Okay, so I don't know if you want to read it from the chat.
From the chat.
Yeah.
Sure. So John mentions here, or asks, that he's lived in their present house for 40 years. There was 1 year early on in which we moved out for a year and let the property, moving our private residence away for that year, then back again. How would CGT be calculated? And is there any inflation allowance, in brackets, house value during our move out very much less than now? So there is a specific calculation for that. And if you think of those 40 years and 39 of them, you lived in the property, with one of them being the 1 year that you moved out of the property. So that private residence relief will be calculated in that respect. I mean, so 39 out of 40 years would be factored into your private residence. That is a more nuanced capital gains tax calculation. So more details would be needed on that in terms of that calculation. So John, happy to take that offline to explore that further. Tim Tanner has a question here. I've owned SSE shares since 1998, and since 2005, I've been increasing my holding via scrip dividends. How do I calculate my CGT liability? While you're holding the SSE shares, while you're still holding it and you're not realizing or liquidating those holdings, then you don't have a CGT liability. But once you start liquidating and selling those shares, that's how you calculate. So you would need to calculate the acquisition cost of those shares in 1998, and then compare them with the potential disposal proceeds that you would receive, and that's how you would calculate your CGT liabilities. Then we look at Nilesh Joshi. We lived in a property as our main residence for 10 years initially. Now the property is let out for the last 5 years. So how CGT will be calculated if we decide to sell the property? Nilesh, that again would be a calculation where you apportion the private residence relief to the period that you lived in the actual property, and the period that was let out will be taken out of that private residence relief. So there potentially would be a capital gains tax bill to settle, but there are reliefs available. So Nilesh, I'll take that offline with you in our follow-up conversation. Mike Cotton has a question. Hi, Greg. Can you confirm the liability of CGT on inherited property? Is CGT due only if the property is sold during the probate period, i.e. if not sold during the probate period, but is sold some years later after completion of probate, is CGT not applicable? Okay, so, and I'll refer to it in one of the slides. So at the point of a loved one passing, that's when the gain or the potential gain on that property disappears, essentially. You will inherit that property at the probate value, and that value, if it increases from that probate value to when the property is potentially sold, and there is a gain at that point, then there would be CGT applicable. So if you inherit that property at £500,000, and that's the probate value, and in the course of the probate period, the property increases in value to 550, then there would be a gain of £50,000 applicable to capital gains tax.
Lovely.
Next question.
I don't think we've got any more questions. We've got someone typing, I think, at the moment.
Okay, I see.
Okay.
Mike Cawthron. Worth mentioning bed and breakfasting. I read that the revenue changed the rule many years ago to prevent you selling an asset one day, thus crystallizing the gain and taking advantage of the annual allowance, then buying back next day. I think it now says that you can only buy back for then a month later, else it is considered the same asset and you will have not crystallized the gain. Is that correct, or are there any other nuances? You are correct, Mike. There's a 30-day time frame to selling down a share, for instance, and then buying that share back. So you are correct there that bed and breakfasting, there is that delay to just basically midnight on the 5th of April, selling down a share and then buying it back a day later. You are indeed correct. That's a nuance there that you'd have to stand down for a 30-day period. Tim, okay, so he just comes back on these scrip dividends. Don't count as they are treated as income, even though they have increased in value. Correct. Those are dividends incomes. They are not applicable to capital gains tax. So that has separate dividends allowances attached to it, which won't take from your annual exempt amount as it relates to capital gains tax. John says you didn't mention if there's inflation allowance on capital gains over a long period. As I said, John, that's a nuanced capital gains tax calculation that I would need to do. So it's, broadly speaking, there is no inflation allowance when it comes to calculating the acquisition cost versus the disposal proceeds, as mentioned. So broadly speaking, no inflation allowance levied over that period.
Lovely. Okay, I think that's all of the questions answered that have come through so far. So thank you very much, Greg, for that presentation and your time. What I'm going to do is I'm going to leave a survey up now for anyone who has got the time to go through that for us and to leave a little bit of feedback, like I mentioned before. Otherwise, we will see you next month on June the 22nd for Kat's webinar. As Greg mentioned, she's going to be going through pension legislation changes and what this means going